One company made $65 billion last quarter selling AI chips. That's more revenue in 90 days than Nike makes in an entire year. And Wall Street thinks it's just getting started. But here's the part that should really get your attention. The biggest tech companies on Earth are now building their own chips to stop paying NVIDIA's prices. This is the AI chip war. And it's about to reshape the entire semiconductor industry. I'm Adrian. Let's break it down. So first, the numbers. NVIDIA reports earnings on February 25th. Analysts expect revenue near $65.6 billion for the quarter. Earnings per share around 1.52, up 71% year over year. This is a company that has more than tripled its revenue in 2 years. And the reason is simple. Every major AI model in the world runs on NVIDIA hardware. GPT, Claude, Gemini, Llama, all of them trained on NVIDIA GPUs. The H100 and H200 chips have become the picks and shovels of the AI gold rush. Jensen Huang calls it sky-high demand. Goldman Sachs sees 35% upside from current levels. And data center revenue alone is expected to carry the entire quarter. So if NVIDIA is doing this well, what's the problem? Here's where it gets interesting. The problem is the NVIDIA tax. When you're the only game in town, you can charge whatever you want. And NVIDIA does. Their margins are enormous, north of 70% on data center chips. Now imagine you're Meta, spending tens of billions on AI infrastructure every year. Or Amazon, guiding for $200 billion in CapEx. Or Google, with a $240 billion cloud backlog. At that scale, even a 10% efficiency gain in your silicon saves you billions. So what do? You build your own chips. And that's exactly what's happening. Google has been doing this the longest with their TPU chips. They just launched TPU V7, codenamed Ironwood, built on 3-nanometer technology. 192 gigabytes of memory, designed specifically for the multi-trillion parameter models of tomorrow. Meta is building its own chip called MTIA. They're now on version 4, Santa Barbara. It's liquid-cooled and designed for 180 kilowatt AI clusters. Amazon has Trainium 2, custom silicon for AWS. Their entire $200 billion CapEx plan is built around reducing dependency on external hardware. And here's the real bombshell. OpenAI and Anthropic, the companies behind ChatGPT and Claude, have both signed deals with Broadcom to co-design custom AI chips. OpenAI is building custom accelerators for their 10-gigawatt data center projects. Anthropic committed over $10 billion for custom silicon. So now you might be thinking, is NVIDIA in trouble? Not yet, and probably not for a while. Here's why. Custom chips are designed for specific tasks, usually inference. NVIDIA's GPUs are still the best at training, the most computationally expensive part of AI. Building custom silicon takes years and billions of dollars. And NVIDIA isn't standing still. Their Blackwell architecture is already shipping. But here's the nuance that matters. The AI chip market is no longer a one-player game. It's becoming a 3-layer ecosystem. Layer 1, NVIDIA. Still the king of general-purpose AI compute. Best training hardware. Massive software moat with CUDA. Not going anywhere soon. Layer 2, Broadcom and TSMC, the architects and manufacturers of custom silicon. Broadcom's AI revenue is projected to hit $46 billion in 2026, up 134%. They're building the chips that Google, Meta, OpenAI, and Anthropic are designing. TSMC manufactures nearly all of them. Layer 3, the hyperscalers themselves. Google, Amazon, Meta, Microsoft. Building custom chips to optimize their specific workloads and reduce costs. So what does this mean for you as an investor? Here's my take. The AI chip boom is not a bubble. It's an infrastructure build-out, like the railroad boom or the telecom build-out of the 1990s. But not every company in this space will win equally. NVIDIA is the safest bet for now. Their earnings report on February 25th will likely be another blowout. But pay attention to their guidance, especially on margins. If custom silicon starts eating into their pricing power, you'll see it there first. Broadcom is the dark horse. Most people still think of them as a networking company. But they're quietly becoming the backbone of custom AI silicon. $46 billion in AI revenue this year is not a side project. It's a transformation. TSMC is the foundation. Everyone needs them. NVIDIA, Broadcom, Apple, AMD, they all depend on TSMC's manufacturing. If you want exposure to the AI chip boom without picking winners, TSMC is as close to a sure thing as you'll find. And AMD? They're fighting for second place behind NVIDIA with their MI300 chips. Solid technology, but they're caught between NVIDIA's dominance and the custom silicon wave. The bottom line is this. The AI chip war is not winner-take-all. It's a massive, expanding market where multiple players can thrive. But the dynamics are shifting from one dominant supplier to a more diverse ecosystem. And the companies that understand this shift early will be the ones that profit the most. Watch NVIDIA's earnings on February 25th. Watch Broadcom's trajectory. And don't sleep on the custom silicon revolution. The future of AI isn't just about models. It's about the chips that run them. If you found this valuable, subscribe and I'll see you next time.